Have you ever wondered how the stock market works? Well, let's unravel this mystery together. Investing, in a nutshell, is the act of putting your money to work. It's about allocating your funds into financial schemes, shares, property, or even a commercial venture, all with the hope of raking in a profit over time. Now, picture the stock market as a grand marketplace, bustling with activity. It's a public domain where company stock and derivatives are traded. But instead of haggling over the price of apples or oranges, here, people negotiate on the price of company shares. It's a dynamic, ever-changing landscape that mirrors the ebbs and flows of our global economy. But don't be intimidated. Sure, the stock market can seem like a labyrinth at first glance, yet, armed with the right knowledge, it can turn into an exhilarating path towards wealth creation. Understanding the basics of the stock market can seem daunting, but with the right knowledge, it can become an exciting avenue for wealth creation. So how does one go about investing in the stock market? Well, let's delve into the process and break it down. First and foremost, it starts with research. It's not just about picking a company because it's trendy or because you like its products. It's about digging deep into the company's financial health, studying its balance sheets, income statements, and cash flow reports. It's about understanding the company's business model, its competitive position in the market, and its growth prospects. It's about staying informed about the overall economy and market trends. In short, it's about becoming an informed investor. Once you've done your research and chosen a stock, the next step is to decide how many shares you want to buy. This decision is often influenced by how much money you're willing to invest and the current price of the stock. It's important to note that you don't need to have a lot of money to start investing. You can start small and gradually increase your investments over time. The third step is to choose a type of stock order. There are several types of orders you can place, including market orders, limit orders, stop orders, and stop limit orders. A market order is a request to buy or sell a stock at the best available price. A limit order is a request to buy or sell a stock at a specific price or better. A stop order is a request to buy or sell a stock once it reaches a certain price, while a stop limit order is a stop order that becomes a limit order once the stop price is reached. The final step is to purchase the stock. You can do this through a brokerage account. Once you've placed your order, the brokerage firm will handle the rest. They'll buy the shares on your behalf and deposit them into your account. And there you have it. Those are the basic steps of investing in the stock market. But remember, investing is not just about buying and selling stocks. It's about making informed decisions based on careful research and planning. Investing is not a gamble. It requires careful thought, planning, and insight. Now that you know the basic process, what are the types of investments available to you? Let's start with shares, also known as equities or stocks. When you buy shares, you're essentially purchasing a piece of a company. As the company performs well, the value of your shares goes up, leading to capital gains. But remember, if the company underperforms, the value of your shares may decrease. Next up, we have bonds. Bonds are like IOUs issued by entities, typically governments or corporations. When you buy a bond, you're lending money to the issuer for a fixed period of time. In return, they promise to pay you regular interest and return the principal at the end of the term. Bonds are generally considered less risky than shares, but the returns may also be lower. Then there are mutual funds. A mutual fund pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They are managed by professional fund managers, making them a good option for those who prefer a hands-off approach to investing. Exchange-traded funds, or ETFs, are similar to mutual funds, but have a key difference. They can be bought and sold on the stock exchange just like individual stocks, offering more flexibility. They also often have lower fees than mutual funds. Lastly, let's talk about real estate. Buying properties for rental income or capital appreciation is a popular form of investment. Real estate can provide a steady income stream and potential tax benefits. However, it requires significant capital and management effort. So we have shares, bonds, mutual funds, ETFs, and real estate. These are just some of the investment options available. Each has its own potential benefits and risks. Shares in real estate can offer high returns but come with higher risk. Bonds are generally safer but offer lower returns. Mutual funds and ETFs provide diversification and professional management, but their performance depends on the skills of the fund managers. Each type of investment carries its own set of risks and rewards, so it's crucial to diversify your investment portfolio. You may ask, isn't investing risky? Well, the answer is yes. But here's the thing, life itself is full of risks. Whenever you cross the street, there's a risk. Even when you decide to stay in bed all day, there's a risk. The risk of missing out on life's opportunities. Investing is no different. It involves risk. but it also offers the potential for reward, the chance to grow your wealth. The key is to understand that risk and reward go hand in hand in the world of investing. Generally, the higher the potential returns, the higher the risk. Think of it as a seesaw. On one side, you have risk, and on the other, reward. However, it's important to know that not all risk is bad. In fact, taking on some level of risk is necessary if you want your money to grow. It's like planting a seed. There's no guarantee it will grow, but without planting it, there's no chance for a tree. Now, everyone's tolerance for risk is different. Some people might be comfortable taking on more risk for the chance of higher returns, while others prefer to play it safe. Understanding your personal risk tolerance is a crucial step in your investing journey. Remember, investing is a long-term commitment. Patience and discipline are key. In the world of investing, knowledge is power. As we navigate through the captivating maze of the stock market, it's essential to grasp the basic tenets of investing. Remember, it's not just about pouring money into stocks and bonds, it's a process of strategic planning, careful analysis, and calculated risks. It's about finding that sweet spot where your financial goals meet the right investment opportunities. Now let's take a quick recap of our journey. We started with understanding the basics of investing, where we saw that investing is a means to grow our wealth over time, and not a get-rich-quick scheme. We learned about the process of investing, which involves setting financial goals, researching different investment options, and monitoring our investments regularly. We also explored the various types of investments, from stocks and bonds to mutual funds and real estate. Each investment type carries its own set of risks and rewards, and choosing the right mix depends on our personal financial goals, risk tolerance, and investment horizon. And finally, we delved into the concept of risk and reward. In the investment world, high potential returns often come with high risks. But remember, understanding these risks and managing them effectively is what separates successful investors from the rest. So, keep learning, keep researching, and most importantly, start investing. Remember, the journey of 1,000 miles begins with a single step. With the right knowledge and mindset, anyone can become a successful investor.